My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. I'll be with my friends. I'm just trying to help you make some money. My job's not just entertainment, to educate, teach. Call me, 1-800-743-CBC. Tweet me, @Jim Cramer. Look, this market is not experiencing a small cap rally. It's experiencing a rally in everything else but the tech titans. The mega caps have become what we call shared donors for virtually every other stock in the market. It's not a rotation at all. It's the great broadening, and we have to embrace it as bullish, not bearish. Except for the big cap techs that report this week, which are stalling out daily and seem to just run into selling every day at the close. So on a day when the Dow ended down 49 points, S&P gained 0.08%, and the Nasdaq rose 0.07%, I say we celebrate the market's good breath. I want to put some examples in your face so you know we aren't being led solely by a bunch of small cap companies that aren't and are doing well. See, many of the small cap companies are really bad stocks and bad companies. And their stocks are only being bought as part of a larger basket, like the Russell 2000, the S&P Small Cap 600, or even the S&P Mid Cap 400, which I know sounds like our NASCAR race. But it represents the most undervalued part of the economy. The big institutions don't have the time to examine all these different smaller cap stocks. They just treat the Russell 2000 like they do the S&P 500. And they buy the index itself as an entity because it is still historically cheap, even after this rally. That's the broadening. Okay, so the broadening is some real trash as well as some treasure. The treasure being companies that do better when interest rates go down, like when the Fed starts cutting. The tech titans, so rich, don't need the public debt markets to prosper, so they don't get much benefit from lower rates. That's not the case with the small caps. So you can see why people would sell the tech titans that are already up huge for the year and cycle into the cheaper small cap stocks as a group, even if many of them are just plain awful. When you buy an index, you always got to take the good or the bad. But you know what? It's not just the Russell 2000, of which, by the way, I'm tired of hearing about. So I say this. Let's look at some individual stocks that have tacked on billions of dollars in market capitalization as part of the great broadening that is, alas, much more permissive than anything we've seen in ages. So you know that this is not just some sort of small cap romp, even though that's what you keep hearing every day. It's wrong. Take McDonald's. Now, this stock has gotten no love. It's seen as a loser because its meals cost too much. The golden arches has fallen from 302 to 243 at its lows in a few weeks. It's a total. So this morning when McDonald's, a $188 billion company, not small cap, reported disappointing same-store sales, down 1 instead of up 0.84%. Substantial sales miss, 10-cent earnings miss off a 307 basis. I saw the numbers. I said to everybody in the room, all right, this one's going to soar. I mean, everyone looked at me like, well, what is he talking about? But sure enough, McDonald's jumped nearly 4% today. So there's no doubt that when Wall Street was still in love with the Magnificent Seven, a stock like McDonald's would have been pelted into submission after reporting such dismal numbers. But the market's fallen out of love with the Seven. And frankly, nobody was truly disappointed by McDonald's because everyone expected them to have bad numbers. I mean, give me a break. The fact that McDonald's articulated a plan to return to growth, including $5 value meals, was enough to get everyone excited about this one. Hey, you know what? We saw the same thing on Friday with the $69 billion 3M and the $99 billion Bristol Myers reported on Friday. Both had a ton of good things to say. Now, Bill Brown, the new CEO of 3M, spent most of his conference call actually talking about how he sees many areas where costs could be cut. He saw multiple segments that could grow faster. That's all it took for the stock to rally 23%. What you'd expect if 3M had gotten a takeover bid. I say that's just playing catch-up as part of the great broadening, although Bill is an inspiring fella. Bristol Myers did raise the range of its full-year earnings forecast pretty substantially, which is a huge positive. Company also earned $2.07 per share. Street was only looking for $1.62. Everyone had given up on this one. That plus some news on a hopeful slew of new drugs got the stock rallying more than 11%. That's the most in 20 years. A broadening needs Bristol Myers. They can't just rely endlessly on Eli Lilly. What happened at Bristol is that after years of repeatedly missing the estimates, a new CEO came in, and now they're knocking it out of the park, not unlike 3M with the new CEO. Of course, it's not just these big caps. We're seeing a remarkable run in the heretofore disliked smaller semiconductor stocks. If you take one look at the SMH Semiconductor Index, you'll see a wholesale redistribution from the once loved NVIDIA to everything else. Take this morning. Early morning, one semiconductor reported, and we've gotten used to it missing the numbers. It's kind of like an old shoe missing numbers at this point, but not this time. It beat the estimates. earning 96 cents versus 92. Wow. And it rallied over 11%. CEO Hossein El-Khoury had a lot of good things to say. I'm going to quote him. We are seeing some stabilization in demand in our core markets, he told us. He went on, we expect parts of industrial, such as energy infrastructure, to recover in the second half. Not only that, he says that China's recovering in both industrial and auto. Boy, they got some big orders from VW brands, too. NVIDIA may be the stock that keeps on giving market cap. The former President Trump keeps antagonizing Taiwan and demanding the geopolitical equivalent of protection money. All of NVIDIA's chips are made in Taiwan, for heaven's sake. This stock's just not been able to rally ever since former President Trump made that statement. Out of Taiwan into America, sure. Makes sense. As more, as long as it's more bite-sized, like an ON, or Skyworks, a Corvo. Sure, the Russell 2000 is talked about endlessly. But have you seen the S&P Midcap 400 since the month began? Vroom, vroom. That's me making an auto sound. Super funny. Laughing on the inside. What's leading the charge? 3 of the top 10 stocks are banks. Wow. Hey, they've all experienced rallies of tremendous proportions. Like, take First Financial Bank shares of Abilene, Texas. That's number 1. On July 10th, the stock was at 29. Now it's at 38. Nothing happened. How about number 2? You may not know South State down in Columbia, South Carolina, but this quiet regional powerhouse has seen its stock go from 75 to 98. Third, Tacoma's own Columbia Banking System. The system stock was at 19 back on July 10th. Now it's at 26. Every one of these moves are what you'd expect from a takeover bid if you didn't know better. Here's something that makes sense. There are 3 home builders on the top 10 list. KB Home, Toll Brothers, Taylor Morrison. When interest rates go down, these stocks soar, even if there are no near-term number surprises. Number 8, one of my faves, Fortune Brands Innovations, a fabulous company that we've had on, which makes all sorts of high-end fixtures for housing, and it put out great numbers on Friday. That's exactly what should happen right now in the business cycle. It's fitting. It's fitting. They're all mortgage or home equity plays. Of course, that's kind of the issue with the move. It's so fitting that it's almost by rote. We now love those new unheralded stocks. We hate the old tried and true fabulous companies. Money's coming out of what has been running for a long time and going into cheap stocks of companies that benefit from lower rates. Does Microsoft, which reports tomorrow, really gain or lose from rates? Not at all. It doesn't need to borrow any money. How about Meta, which reports on Wednesday? Immune from rates. And then Thursday, the day of days, Apple and Amazon have nothing much to do with rates at all, even as both their products have cost consumers a lot of money. Maybe these stocks can advance, but the bar is set so high it will be hard for them to excite or enthuse when we are at the beginning of a rate cut cycle. So the bottom line, I guess you're supposed to sell companies that have nothing to do with rates and buy stocks that can benefit from lower rates. That's the great broadening trade, people. And when you put it in that proper context, you know it's got some staying power, at least until the small, medium-sized catch up to the Magnificent Seven. Although if that's what's needed, an awful lot of points will have to be transferred from the 7 to the small fry to complete this rotation. I want to start with Dave in California. Dave.
Booyah, Jim.
Booyah, Dave. What's going on?
Well, I've been a club member for almost a year now, and I've been learning a lot.
Thank you.
And in light of your terrific interview with the Commerce Secretary last week and their future technology plans, she mentioned Texas Instruments. And is this that they had a good relationship with Texas Instruments? And is this a good time to restart a position?
Yes, it is, and I'll tell you why. Just like On Semi reported good numbers and Texan did report good numbers, you have an activist in there, Elliott Partners, that can make a lot of things happen. By the way, they're in Starbucks, and I think they can make a lot of things happen there. And in Southwest, Texas Instruments is a great story company, 2.5% yield, and I think they're going to have a very big meeting that's going to tell you, lay out the strategy, and the stock's going to go up well in advance of that. I want to go to Robert in New York. Robert!
Jimbo, I miss talking to you. It's been about 2 weeks, and I got to tell you, Jim, you're amazing. Tomorrow's my birthday, and last time I sang happy birthday to you, if you remember.
I enjoyed that.
I know you did. It was pretty cool.
Hey, I mean, if you like your reviews yourself, absolutely.
Jim, I gotta tell you, it's been 1 year that I've been speaking to you, and it's been a thrill of a lifetime to call into your show because you have made me so much money. In the 1 year is my birthday.
Well, there you go. Happy birthday. And I love that. See, I love that.
No, happy birthday to me. Happy birthday to me. Thank God for Jim Cramer. He's made me tons of money.
Well, don't quit your day job, partner. But I like that. Anyway. I like that. I like the whole theme. I like the theme of it. And I'm going to play that in a continuous loop to my wife, Lisa, until she starts realizing that I'm a good guy.
Well, Jim, you're not a good guy. You're a great guy. But let's get on with it.
Just a second. Let me get on the phone. No, that's wrong. No, that was a mistake. That was a mistake. I made a mistake. I violated all of TV rules just then, and you won't see me for the next 40 years. Tell me what's going on.
Jim, I love you, Jim. This stock has really done well in the last number of months, driven by the company's strategic initiatives and market conditions, especially in its investment banking sector. Their wealth management sector has been increasing also. I would think that if the Fed cuts rates, this stock will go much higher. Morgan Stanley.
I agree with you. I agree with you on everything on that call, frankly. I mean, let me tell you, Morgan Stanley, when we do pieces about these big IPOs and we get a lot of takeovers, you're going to see Morgan Stanley go higher and higher and higher. And I want to thank Robert in New York and Dave in California. They bring it. They bring it every time they call. Club member. This is the great broadening trade, people. It's not big cap into small cap. Get that out of your head. Look, this is when you donate great points from the big guys to the little guys. And you know what? I think you're going to have something with great staying power because of that. On Mad Money tonight, potato company Lamb Weston has been getting fried. So is there any hope for the stock becoming a hot potato? I'm running through the latest. Then last week we got the largest IPO of the year, Lineage, and the market seemed to like it, but where do I come down? I'm going to give you my thesis on the newly minted stock. And Columbia Sportswear was just about flat in last year, so what is going to take for the outdoor apparel company to finally break out? I'm seeing where things stand with the CEO, so stay with Cramer!
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Last week, the stock of Lamb Weston blew up. This company that supplies frozen potato products to restaurants and retailers saw its stock fall more than 28% on Wednesday in response to a truly heinous quarter. Worse, this is their second implosion in a row. When Lamb Weston reported in April, its stock fell nearly 20% in a single session. Sell. At this point, the stock's down 48% for the year, making this purveyor of French fries the third worst performer in the S&P 500 in 2024, a striking decline for what used to be considered one of the premier packaged food companies. For the uninitiated, Lamb Weston has been a leader in the frozen potato industry for more than 70 years. Now, these aren't frozen, and they really stink, but that's okay. Until 2016, it was a division of Conagra. But since the spinoff, it's done very, very well. From late 2016 through its peak last year, the stock rallied nearly 300%. But now suddenly it's become one of the worst stocks in the market.
That was easy.
And Conagra now looks like a smarter company than we thought about the spinoff. With that decline, we got to ask, what the heck is going on? Technically, the trouble started when Lamb Weston reported a year ago, July of 23. Well, there was nothing really wrong with the numbers. The stock didn't seem to care. In fact, it kept sliding for the following months, call it late July to mid-October 2023. It's part of the broader beatdown in the food stocks created by the initial GLP-1 scare. You know, those weight loss drugs. That first move, as everyone was terrified of new weight loss drugs, they'll reduce craving for junk food. And it brought down practically everything. I mean, it can even do this. It can make it so you don't want these. It was indiscriminate, but at least when it comes to Lamb Weston, the rise of GLP-1 has changed the whole narrative. Before, frankly, the thesis for Lamb Weston was pretty simple. People love French fries and tater tots and other potato products, so the company could keep growing nicely as it expanded into different channels and markets around the world. But after last fall, we've had to reconsider whether that story still works in a GLP-1 world, because junk food, well, let's say almost all the companies that make junk food are guilty until proven innocent these days. At first, Lamb Weston didn't seem like it had a problem. It reported very good quarters in October and January. Things were really going fine with the story until suddenly they weren't. The trouble started in April when Lamb Weston reported a shockingly bad set of numbers. In fact, it was a very bad combination, a huge revenue and earnings miss. Net sales came in at $1.46 billion. Wall Street wanted $1.65 billion. Their earnings shrank by 18%, falling to $1.20 per share. Analysts were looking for $1.45. Worse, management cut their full-year guidance. A across the board, and it was in the most embarrassing way. See, in January, Lamb Weston raised its full-year earnings forecast. In April, they repealed that entire boost and then some. It sure did make management seem really clueless. They know nothing! Of course, in April, Lamb Weston had a legitimate excuse for the sudden reverse of fortune. In fact, they gave you a couple of reasons for the weakness at that time. But investors only paid attention to one of them. That's the company's transition to a new enterprise resource planning system, ERP system in North America. Now, see, when you make a change in resource planning, if it goes poorly, the consequences can be pretty dire. I don't blame anyone for focusing solely on that issue in April, because that's exactly what Lamb Weston's management did on the call. At the time, even though the stock got crushed, there wasn't a widespread sense that anything else was wrong. A lot of folks assumed this was a one-off problem that could easily be overcome, because remember, this stock had been a total home run for a long time. But if you read the report a bit more closely in April, you would have found some clues that something else was afoot. Specifically, when management cut their full-year forecast, they alluded to, and I quote, soft near-term restaurant traffic and retail trends in North America and other key international markets, end quote. I don't know. To me, it sounded pretty serious. Remember, this spring was when we started to hear rumblings about softness in certain lower-income corners of the consumer space, but pretty much everybody assumed Lamb Weston's problems were on the resource planning side, rather than slowing end markets like McDonald's, where they happen to be a supplier to McDonald's. I mean, it's just potatoes, for heaven's sake, right? Flash forward to last Wednesday, and we realized the truth. This time, the company's net sales declined by 5%. That's a major shortfall. And the earnings were worse, down 40% year over year, coming in at 78 cents per share. You know what Wall Street was looking for? $1.26.
The House of Pain.
This was the final quarter of the fiscal year, too, and Lamb Weston's full-year earnings still came in lower than their already lowered guidance from April. That's terrible. Worse still, management issued a very pessimistic forecast for their new fiscal year, talking about $4.35 to $4.85. The Street was looking for $6.10. Man, that's a big miss. This time, there was very little talk about enterprise resource planning. CEO Tom Werner didn't beat around the bush, saying, quote, our price/mix results were below our expectations, while market share losses and a slowdown in restaurant traffic in the U.S. and many of our key international markets were greater than we expected. We also incurred losses related to a voluntary product withdrawal. Man, that's nasty. Now, looking forward, Werner warned that, and I quote, we expect fiscal 2025 to be another challenging year. The operating environment has changed rapidly over the past 12 months as global restaurant traffic and frozen potato demand softened due to menu price inflation continuing to negatively affect restaurant traffic, end quote. Then he goes on to say, quote, this has resulted in an increase in available capacity in North America and Europe. We believe this supply-demand imbalance will persist through much, if not all, of fiscal year 2025, end quote. It's a good old-fashioned potato glut, the opposite of the Great Famine of 1848. But maybe we should have seen this coming. This is exactly what we've been hearing from the restaurants themselves, the customers. The ones that raised prices too aggressively over the past few years are losing traffic. And the customers who do come in might not be ordering as many things, including fries. I can't believe that because the fries are so good, but it does happen. That means Lamb Weston either needs to compromise on price or lose its business entirely. Compromise on price means estimate cuts. Still, after this mammoth decline, do we think the stock's a lost cause? I'm not ready to go there. No. I think you need to be careful for the next quarter, maybe even the next year, but I think they de-risk this thing. I smell an opportunity, not those fries. They stink. With this huge pullback, again, the stock's being cut in half, for heaven's sake. It now sells for 12.5 times this year's earnings estimates. Even if Lamb Weston disappoints by about 50 cents per share, and you assume it deserves to trade at a 20% discount to its historical valuation, that would still make it an $80 stock. That's up more than 40% for where it's currently trading. Also, remember, by the time we get to next spring, the company will start lapping these easier quarters. And we heard from McDonald's, they're going to keep the things down, right? Keep the prices down. A little more customers are going to come back. Honestly, my real concern is still that impact of the GLP-1s on all things starch. Maybe it's a consequence of these drugs. The whole quick-serve restaurant space will be in big trouble. That said, I don't think we're there yet. Right now, it's the consumer pushback against higher prices that's crushing this industry. Not enough people on those drugs, at least not yet. The bottom line, I'd be a buyer of Lamb Weston into this extreme weakness. Now, I know that's very contrary, so you want to buy slowly because things could get a whole lot worse before they get better, although remember, McDonald's stock was up today. That matters. Over time, though, I'm betting that the great potato glut will come to an end, and Lamb Weston will be just fine. Mad Money is back after the break.
Coming up, a warehouse player of noble descent? Don't miss Cramer's take on the market's latest IPO. Next.
during the extreme action, but we got a ton of activity from the IPO market last week. 4 separate companies raising over $100 million, according to Renaissance Capital, the leading IPO research firm. This is the first time that's happened all year. In fact, we got the largest deal of 2024 last week. Lineage is a real estate investment trust that operates the world's #1 network of cold storage warehouses. It raised more than $4.4 billion. The deal priced at $78 is down $86 stock, and you could get in on it. There was a lot of stock for sale. Given the scale of this one, I think we should take a closer look at it. Lineage is basically a cold storage roll-up. They add different businesses together. Back in 2008, a couple of former Morgan Stanley investment bankers, smart fellas, bought their first cold storage facility in Seattle. And since then, they've made 116 acquisitions in order to become the largest player in the industry. 482 warehouses containing 3 billion cubic feet of capacity. These guys control a third of the cold storage market in North America. The closest competitor only has 19%. Good business. Lineage operates these temperature-controlled warehouses, and they also provide their customers with supply chain services. They're an essential link in the food chain, which is why their customers include some of the largest restaurants and consumer packaged goods companies on Earth. We're talking seafood, poultry, packaged foods, dairy, pork, produce, baked goods, and beef. Basically anything that needs to be frozen or refrigerated gets in one of their places. At the end of the day, this is a pretty standard roll-up story. The ex-Morgan Stanley bankers who created Lineage found a very fragmented industry, in this case cold storage, and used a bunch of acquisitions to build a dominant player in a very short span of time. Now that Lineage is the top dog, it can offer more comprehensive services than its smaller competitors. Scale is a wonderful thing. Management also argues that their industry is uniquely levered to the rise in online food sales. Hey, let's say you're ordering frozen steaks off the internet like I do. Somebody needs a refrigerated warehouse to store the stuff in. Lineage also benefits from a younger generation that's obsessed with healthy eating because they want more fresh foods with less preservatives. Again, what do you need? Cold storage. Lineage also mentions that they've invested more than $1 billion over the past 5 years in technology initiatives. Big move to the cloud, something that management says can help them win business, operate more efficiently. I think they're probably right, but I hesitate to play up the tech angle because in the end, it's a warehouse company. Now let's talk numbers. Lineage has grown its sales from $3.7 billion in 2021 to $5.34 billion last year. In terms of profitability, their net operating income grew from $1.13 billion, in 2021 to $1.75 billion last year. Adjusted funds for operations, this is the key metric for REITs, came in at $466 million in 2021 before jumping to $845 million last year. That said, in the first quarter of this year, the latest set of numbers we have, Lineage growth slowed dramatically. Quizzical even disappeared. Revenue was down 0.4%, while net operating income was up just 0.1%. And adjusted funds from operations increased by 20.4%, which is good, but not compared to the 53% growth last year. So we need to ask ourselves if this is a new normal after previous years where Lineage got a big boost to its growth thanks to a steady stream of acquisitions. This is a very important question. I don't have the answer. Beyond that, my one big concern about Lineage is that all the deal making over the past decade, and actually it's been a decade and a half, has left them with a substantial debt load. As of the end of March, the company had $9.25 billion of net long-term debt, substantially more than the roughly $5 billion of stockholder equity at the time. Their net debt long-term debt was 7 times last year's adjusted earnings before interest, taxes, depreciation, and amortization. And that's a very high ratio, not what I want to see. Because Lineage's debt is so high, they plan to spend pretty much all the $4.4 billion they raised in the IPO on cleaning up the balance sheet. Of course, in a perfect world, you'd like to see them use these proceeds to grow the business, but at least they're taking a major risk off the table, the one I'm most worried about. Finally, given that this is a real estate investment trust, let's talk potential dividends. Lineage says that long-term it intends to distribute roughly half of its funds from operations to shareholders. Considering what they made last year, it would have worked out to $1.73 per share dividend in 2023. With the stock at 86, it represents about 2% yield. Not great. Of course, the funds from operations grew by 20% in the first quarter. But I think the share count figure in the prospectus might end up being a lowball number. So a 2% yield sounds about right to me. Not what I want, but it's got some growth. So if you like the cold storage business, what should you be willing to pay for Lineage? Thankfully, we do have some clear comparisons here. The second largest player in cold storage is Americold, which is also a publicly traded REIT. Americold sells for 20 times this year's funds from operations estimate with a 3% yield. If we assume that its 20% funds from operations growth continues for the full year, Lineage is a touch more expensive at 21 times this year's numbers, although I expect the dividend to be lower. If you look at other logistics REITs, like Prologis, they're on time, right? Trades at 22.8 times this year's funds from operations with a 3.1% yield. Long story short, the valuation seems reasonable. Well, I don't want to pound the table on this one. I say modestly positive here. I'd like to see more details before giving a wholehearted endorsement. Got to know where the future growth will be coming from after that last quarter and what the dividend will actually look like, because that's why people buy these stocks. But with the information that we have now, I think there's plenty to like about Lineage. My biggest concern was that balance sheet, but that's less of a concern after the company used most of the proceeds from this deal to pay down debt. Valuation-wise, stocks seem to be right where it should be, which is nice to see. After so many IPOs from the past 5 years just zoomed immediately to irrational levels. Bottom line, now you know what you need to know about the year's largest IPO, Lineage Inc. I hope to be able to do more of these Know Your IPO segments as more companies come public that are worth talking about. Although August is usually slow on the deal front, we might see another wave of IPOs in the fall. Who knows? It's a pretty positive market right now. Let's take calls. Let's go to Bob in New York. Bob.
Hey, Jim. How you doing?
I'm doing well, Bob. How about you?
We're hanging in there, buddy. Hey, Jim.
All right.
Starwood announced their dividend for the next 2 quarters. That's something I've never heard about before. And secondly, what do you think of Sternlicht? Is he still scaring you away from Starwood?
Well, I mean, look, the problem with the CEO, who, even though he may have declared the dividend twice, is that if he scares me, I'm not on board. Because everybody else could bring him down, even if he's doing well. And that's why I said, you know what, I used to endorse this thing for many years, but it's done absolutely nothing. So it's not like I missed anything. You get the dividend, but I want more than a dividend if I buy stocks. If I want to get a high-yielding dividend, if I want a big dividend, I'll just go buy a bond. I don't need that extra risk from being in an industry that this man, Barry Sternlicht, tells me is not doing well. Let's go to Hunter in Arizona. Hunter.
Happy Monday, Mr. Cramer.
Oh, you bet. How about you, Hunter? What's happening?
Shout out to Asset Work Discord. I want to know what you think about MPW and adding it to a long-term
I think that
portfolio.
No, I think that yield is too high. That's a red flag. I wouldn't touch that thing. Please don't touch it. Let's go to Jeff in Connecticut. Jeff.
Yeah, Jim, long-time listener, first-time caller. Your show is
excellent.
Great.
Thank you.
I own a stock. It's listed in the home builders industry, but it doesn't really build homes. They buy the land, do all the prep, and then sell it to the home builders. It's a 4-star, FOR. Looks pretty.
Well, I don't know 4-star. I'm going to have to do some work and come back. I think that's a kind of an interesting idea to find a residential real estate play like that. But I really, I know Toll, I know Lenore, I know Horton, I know Pulte, and I like all of those. But I do not know 4-star, and I've got to do some work. All right, look, I don't want to pound the table yet on Lineage, but I do think there's a lot to like here. Valuation-wise, the stock seems to be kind of where it should be. That's refreshing to see, isn't it? Now, much more Mad Money, including my exclusive with Columbia Sportswear. With the stock moving higher today, our investors signaling that the apparel company's recent mixed quarter is now behind it. I'm trying on the story for size with the company CEO. Then on Friday, a jury ordered Abbott to pay $495 million related to premature infant formula. I'm breaking down the verdict and what it could mean for the entire industry. And the order calls rapid fire in tonight's edition of the Lightning Round. So stay with Cramer. What's happening at Columbia Sportswear, the outdoor-focused apparel and footwear company with big brands like Columbia, Sorel, Prana, and Mountain Hardwear? Last week, the company reported better than feared quarter, although management did cut their operating income guidance. In response, the stock dropped 1% on Friday, although rebounded more than 3% today. So is today's action telling us that the apparel negativity is baked in? Let's check in with Tim Boyle. He's the chairman, president, and CEO of Columbia Sportswear to get a better sense of the quarter and where it's headed. Mr. Boyle, welcome back to Mad Money.
Jim, thanks for inviting us here.
Well, I got to tell you, Tim, this was the quarter that I'm so fearful of happening around all the world, which is that we're the slow ones. That suddenly out of nowhere, maybe because it's political, maybe because of problems we don't know with inflation, but it looks like that our country is no longer as good a retail environment as some of your other areas.
Well, it's a little bit of an unusual one, as you mentioned, but secondarily for our company, this is always the smallest quarter of the year. So any particular issue can get modified and accelerated. So, we're still bullish on the business, obviously, and the U.S. is, a great place to live. And the reason our company does so well is because consumers around the world recognize America and especially the American West. So things always get a little turbulent when there's an election going on. And we're great that we have places in the world that are more robust than here.
Including, it sounds like, China, where most people are seeing a definitive slowdown, particularly on sports and apparel.
Well, you have to remember, and we've been quite open about the fact that we underperformed in China for a period of time. We've got a great team there, so we're coming out of it, and we're growing. And we've got a really good team there that really understands the market. And so there's lots of opportunity for us there. We think that'll be our largest growing market at some point in time. But yeah, we've just reinvigorated the brand.
Well, you continue to innovate, and I am particularly interested in what I will just call polar bear technology. I was at this football game. It was the Chiefs versus the Dolphins. It was -9. I was going crazy. Would this keep me warm?
Absolutely. That's biomimicry. So our team here put together an analysis of polar bears, which, as you remember, the fur of a polar bear is actually translucent. So the sun goes through the translucent, hits the black skin of a polar bear, which heats up, and then the fur keeps it insulated and keeps the heat in. So we've got a couple of different technologies around that biomimicry. And believe me, this is going to be a real interesting product for us, and a great story and good opportunity for us to tell consumers more about our innovations.
And will that be direct to consumer? Will it be everywhere? I mean, will I see that in prestige department stores? Will it be in more of outdoor wear?
I'd say the biggest representation is going to be on Columbia.com, where we can really control it. But we have many other customers that are buying it, and it'll be available globally.
I think it's very exciting. I hope you have the scale to pull that one off, because no one's had new technology other than like a battery in your jacket, which is okay. I want what you gave me. Now, Prana, once again, very tough, but it looks like the rest of the industry is slowing down. Is this your turn to shine? Maybe you can do something a little different from the other guys?
Well, we've been, again, very open when we've been underperforming. We've made changes at Prana with the leadership there. We're very excited about the new opportunities there. And similar with Sorel, where we just got ourselves in a position, and frankly, this is a small quarter for Sorel, very small. But we're going to turn those businesses around, and we're well on our way. So we're very excited about the opportunity, and it's going to be good. We've really spent the last year managing our excess inventories and focusing on profitably liquidating that stuff. And now it's time to turn our attention to growing the business again across all of our brands.
Okay, now we do have a lot of product here, including a product that has very soft on the outside. I kind of like it. It feels really cool. It kind of reminds me of like a Colorado thing. Made in Vietnam titanium, which I see in the upper right-hand corner. Now, is that something that we'll be buying in the fall?
Yeah, the titanium products are our best products. And we have a quite broad selection of titanium products across sportswear, outerwear, and footwear. And this is a really good opportunity for us to put together our best technologies and our best thoughts about how to keep warm or cool. And we'll have lots of it available for this coming year. Anything
new with performance fishing? PFG, I went on a fishing trip with my kids. Everyone was jealous because the sun was really bright, and I'm the only one that didn't get completely fried.
Well, what's interesting is we are going to be using and available for spring 25 a great product which we call Sun Deflector. So if you remember the reflective product that we have on the inside of our garments, we've designed a ceramic rendition of that called Sun Deflector, which means the sun will hit that fabric and bounce off and won't create heat and also keep cool. But that's going to be part and parcel of the next lunar lander, which is going to take off sometime in early January, mid-December, early January. And that's going to be connected with the technologies of OmniHeat Infinity, which is already was on the first lander. So we're going to have two Columbia technologies on the next lunar lander launch. And we're very excited about how we can promote those and make sure people understand how important they are for not only keeping people comfortable, but keeping a technology lunar lander in good health on the moon.
That's very cool. I got to tell you, I love your stuff. Everybody does because it's always something new technology. I hope Sorella has a good season. We know that is really crucial to the quarter, but I think it's the technology that's crucial to the company, and you always deliver. And thank you so much for coming on. I hope America picks up when we get to the important quarters, not this quarter.
Absolutely. Thanks, Jim. I appreciate it very much.
Of course, Tim. That's Tim Boyle, Chairman, President, CEO of Columbia Sportswear. You see the stuff. You know the stuff. I wear all this stuff. I don't know about you. Mad Money's back after the break.
Coming up, pop open those umbrellas and tee up your toughest questions. Cramer takes on all comers in the lightning round. Next.
It is time. It's time for the lightning round. Quick back to Africa. Let me say in a second. About buy, sell, just because another call. Stock questions. My staff perfectly. You're playing this out. And then the lightning round is over. Are you ready, Ski Daddy? Time for the lightning round. Cramer's a member. Start with Sam, Massachusetts. Sam.
Jim, listen, we got a stock down 80% from its high in 2021, and that's Illumina. Stock does $4 billion a year. I'm curious.
No Illumina. I like Danaher. Now, I did trim a little Danaher after just a huge battle, but it's a much better company than Illumina. Let's go to Jimmy in Kentucky. Jimmy,
happy booyah to you.
Oh, man, what's happening?
With the recent pullback in Bank of America, and when would be a good entry point?
Right here. You buy some right here. You buy some maybe if it breaks 40. I think this company's selling it very inexpensively, and it's a good one. Let's go to Ann in Indiana. Ann?
Hello? Yep.
Hey, it's Jim. What's going on? Go ahead.
Well, I just feel like an idiot. Constellation Energy. Buy more, hold it, or
look, this is a solar play that is a very good company. It's up a huge amount versus a lot of other stocks. It's up 47% still for the year. I think you can buy some. Please hold on to it. Do not sell it. Let's go to Peter in New Jersey. Peter.
Hey, Jim. Good afternoon. I'm sitting out here in my New Jersey flower garden, waiting to talk to the man. Thanks for taking my call.
Of course.
And here's my question. It's two parts. In regards to Meta, I have about a 1.5 year, 2 year time horizon.
Okay.
My question is on your end, what do you think roughly is the outlook over that period of time?
Okay, so I think the problem with Meta right now is it's going up so much that people are just selling Meta to buy a lot of stuff in the small and medium-sized range. And I don't think that's going to change no matter what Mark Zuckerberg says. So just be aware that the stock's in the doghouse right now, and it could come out of it only after it gets even cheaper. Let's go to Vinay in Iowa. Vinay.
Booyah, Jim. Vinay calling from Iowa. Long-time listener, first-time caller. Your thoughts on ICICI Bank, IBN?
Okay, I think if you want exposure to India, I think it's a great way to get that exposure. And I wouldn't think that I think it might be better than just buying a whole basket. I like that idea. Let's go to Scott in California. Scott.
Jim, I got to say thank you for sharing your opinions with all the experience you have in the market for so many years
thank
now.
You. Thank you very much. Do my best. Thank you.
Hey, so I called you a little over a year ago about a little pharma company that spun off from Merck. And at that time, you weren't too warm and fuzzy about that segment of the market with the whole pharma spinoff.
Right.
But it's been a little while now, and I know since December, they've actually come off bottom, it looks like, and they've been steadily going up. They got a solid dividend track record, and they're profitable, and they're going for less than 6% or 6 times earnings. Am I missing something here, or what's going on with OGM?
What's the stock? Oh, Organon. Yeah, well, look, I missed it. I mean, Pfizer, Organon, these are companies that are just kind of quietly going higher. And I have to admit, that one's probably not done. And that, ladies and gentlemen, conclusion of the Lightning Round.
The Lightning Round is sponsored by Charles Schwab. Coming up, the verdict is in on Abbott Labs, but Cramer isn't done with his closing arguments. Next.
I knew Abbott Labs was in trouble from the moment I saw that their first specialized baby formula lawsuit against them would take place in St. Louis, Missouri, possibly the most pro-plaintiff venue in America. But I didn't know the extent of the damage. Well, after Friday's jury verdict awarding the plaintiff $95 million in compensatory damage and $400 million in punitive damages, it was a lot worse than I thought. Honestly, this verdict is an outrage. Abbott Labs makes a special baby formula at the request of pediatricians and their families, something the American Academy of Pediatrics strongly favors. The Academy says the formula is essential to fighting the effects of necrotizing enterocolitis. That's a serious condition that could be lethal to preterm infants. It's a condition that the plaintiff's lawyers contend Abbott is causing with this formula. These special formulas are often the last line of defense for doctors when a premature baby doesn't have enough mother's milk. If they can't get enough milk from the mother, hospitals turn to donated human milk. If there isn't enough human milk donation, there often isn't, then doctors turn to special formulas made by Abbott Labs and Reckitt Benckiser. Pretty much the whole medical profession regards this specialized formula as a routine and necessary part of care for babies who are born prematurely. They're the ones who use it. Yet lawyers for the plaintiffs in St. Louis argued successfully that Abbott's specialized formula not only caused necrotizing enterocolitis, it also did so with no warning, hence the $495 million verdict. Frankly, I'm at a loss for words about this one. The Wall Street Journal opinion page called it a shakedown. I couldn't agree more. You understand, Abbott only makes this formula because it's the right thing to do. The product only makes them $9 million a year. As CEO Robert Ford told me on Squawk on the Street, quote, if this product were no longer available, there would be a public health crisis, end quote. Well, guess what? With this kind of verdict, Abbott would have to be insane not to pull the specialized baby formula. They can't afford to continue making it. Same goes for competitor Reckitt Benckiser, which recently lost a similar lawsuit that cost them $60 million. The real issue here, of course, is that our justice system handles civil trials like a game of roulette. It's so capricious and arbitrary that Abbott's now being held to an even higher standard than Johnson & Johnson, which made a consumer product, Johnson's talcum powder, with no warning label that cost them $2 billion a quart. Also in St. Louis, Missouri, of course. There are 22 women and their families sued J&J for causing ovarian cancer by failing to disclose their talc-based baby powder had asbestos in it. Even as the government never found that J&J knew about it, and J&J says there's no asbestos in talc in the powder at all. With Abbott, the $495 million penalty for a single person is much bigger, even though their special formula saves lives, and doctors recommend and use it. It's not found in CVS or Walgreens, for heaven's sake. The idea that this stuff causes NEC seems absurd. Plenty of babies get this disease even when they've lived entirely off of milk. It's just a redistribution from Abbott's coffers in the hands of the plaintiffs and their lawyers. And now Abbott may not be able to make this stuff anymore, even though every neonatal intensive care unit in America needs it. The outrageous nature of this whole experience is so stupefying that the market slopped off nearly $30 billion from Abbott's market capitalization since we started worrying about this case. And the government doesn't come to Abbott's aid. It just watches and shrugs. There really is something off about how certain state juries are so friendly to the plaintiffs. It's jackpot justice. But the system we've been living with for a long time is, well, this one. I'm honestly amazed that Abbott stock, after opening down more than 4%, could rally to within 50 cents of its last close. Perhaps that's because the stock's already down. Perhaps it's because Wall Street recognizes a joke when it sees one. If this verdict is really upheld on appeal, then you could argue that it's simply not worth it for a drug company to create anything unless you get the users to sign away the right to sue. It's one thing when we're talking about a consumer product that somehow may have had asbestos in it, like what happened with J&J. But Abbott's only making this special formula for hospitals to prevent a public health crisis. What warning's needed when it's the only alternative for doctors to save babies that have no human milk? If the feds don't lift a finger to help them, what's the point of sticking your neck out like that and making something that could wipe out the company if it keeps losing cases? As the Journal says, no good deed goes unpunished, and Abbott got punished as though it was making a fortune from this formula by hiding risks that they knew about and didn't tell you. In reality, they didn't hide anything. I very much doubt the risk, and the product's a money loser anyway. But hey, that's justice in 21st century America. I like to say there's always a bull market somewhere. I promise to find it just for you right here in Mad Money. I'm Jim Cramer. See you tomorrow.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC, NBC Universal, or their parent company or affiliates, and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Jim Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and or subsidiaries warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.